welcome back to the channel. Today we're putting together this week's watch list with 6 stocks I'm tracking closely: PayPal, Roblox, Enphase Energy, Corsair Gaming, UPS, and Nike. I'll walk through both fundamentals and technicals for each name, so you'll get a full view before the week starts. If you find this helpful, hit like, drop a comment with the stock you're watching most, and subscribe so you don't miss future weekly breakdowns. If you're interested in getting a more in-depth breakdown with guidance on potential options trades, feel free to join the Discord channel, which is completely free. Before we jump into the individual charts, let's set the stage with what's happening this week in the broader market. On the macro side, the big one is always jobs data and activity data. We've got the usual U.S. economic prints through the week: manufacturing and services surveys, job openings, and jobless claims. The main event is Friday's non-farm payrolls report. That jobs number drives expectations for growth in interest rates, which in turn drives how aggressive or defensive investors want to be. A weaker labor market tends to push the market to price in rate cuts, which usually helps growth in tech. A stronger labor market can have the opposite effect. On the earnings side, we're still in the thick of earnings season, and a bunch of big names are set to report that tie directly into our watch list. Monday before the open, we have Disney, and after the close, we get Palantir. Tuesday before the open, PayPal, PepsiCo, Merck, and Pfizer. Tuesday after the close, AMD, Supermicro, Chipotle, Enphase, and Amgen. Wednesday, we get Uber, Eli Lilly, AbbVie, Google, Qualcomm, Snap, and Elf Beauty. Thursday, Shell, Estee Lauder, Amazon, Roblox, and Reddit, among others. From our watch list, the 3 to really watch on the earnings calendar are PayPal reporting Tuesday before the open, Enphase Tuesday after the close, and Roblox Thursday after the close. Combine that with Friday's jobs report, and this week has plenty of potential catalysts. With that context in mind, let's get into the 6 stocks, starting with PayPal. As we referenced last week, PayPal is still one of the core digital payments platforms globally, with a big base of active accounts, strong transaction volumes, and growing revenue per user. The story at this point is less about explosive growth and more about profitability, discipline, and whether this is a value opportunity or a value trap. Fundamentally, PayPal is still solid. It's generating meaningful earnings and cash flow. Margins are healthy for this type of business, and management has been focused on cost control and buybacks. EPS growth has been running ahead of revenue growth as they squeeze more profit out of the existing base. So from a pure fundamental standpoint, this isn't a broken company. It's a company investors are repricing after years of overenthusiasm. Valuation-wise, PayPal has come down a lot from its pandemic highs and now trades on what's generally considered a reasonable multiple for a mature fintech. The stock tends to sit around the low double-digit earnings multiple range, which is cheap relative to its own history and to many other payment names. Analysts still model mid-single to low double-digit earnings growth over the next couple of years. That combination, reasonable valuation plus positive earnings growth, is why a lot of people frame it as a value or turnaround play rather than a high growth story. Key fundamental bullet points you can mention here: solid revenue base in the tens of billions, positive growing EPs, healthy net margins and return on equity, active share repurchase programs helping EPs. The risk on the fundamental side is that growth is slower than the market wants, and competition from Stripe, Block, Apple Pay, and others keeps the multiple depressed. Let's talk technicals. Price-wise, PayPal has been trading closer to the lower half of its 52-week range after a long decline from its peak. That tells you sentiment is still cautious, but we may be in a base building phase. Levels to watch. On the downside, recent lows form a support zone. If price revisits that area and holds, it acts as a reference for risk management. On the upside, you've got a band of resistance where the stock has failed a few times. Call that the first target zone on any bounce. What I like to look for is price starting to hold above the short and medium-term moving averages. Is momentum, things like RSI or MACD, strengthening without being overbought. Are we seeing higher lows and higher highs on the daily chart? If PayPal can push above that first resistance area and hold, especially after earnings, that's your technical confirmation the market is willing to re-rate the stock higher. The big near-term catalyst is earnings on Tuesday before the open. Two ways to think about it. If you're conservative, you wait for earnings, then see did they beat or miss on revenue and EPS. What did they say about guidance and margins? How did the stock react at key support resistance? If you're aggressive, you might build a starter position before earnings, but size it small enough that a gap move in either direction doesn't blow up your risk. My stance for this week are fundamentals, solid, not spectacular. Valuation, reasonable versus growth profile. Technicals, watch for a base and a post-earnings breakout. I'd label PayPal as a hold, selective buy on dips, with earnings as the event that can change the narrative. Roblox is a platform ecosystem play. It's not just a game, it's a user-generated content world where people spend time, creators build experiences, and the company monetizes through Robux and other features. Fundamentally, the story is clear. Top-line growth is very strong. Revenue has been growing at high double-digit rates. Engagement and monetization per user are the key levers. The problem is that the company is still unprofitable and burning cash. So this is a classic high-growth, high-risk tech name where you're paying for future potential, not current earnings. A few points to frame it. Revenue growth in recent quarters has been very impressive. That's why bulls are still in the name. Gross margins are quite high for a platform business, which is a positive sign about the unit economics. But once you move down the income statement, spending on infrastructure, R&D, and sales marketing means the bottom line stays negative. Key questions. Can Roblox grow into profitability over the next 3 to 5 years? Will engagement hold up as tastes change and competition from other platforms increases? Does management have a credible path to dialing back spend while keeping growth intact? This is not in the same bucket as a mature cash flowing company like UPS. This belongs in the speculative growth part of a portfolio. Technically, Roblox has been in a downtrend. The stock has made a series of lower highs and lower lows. Prices tended to trade below key moving averages, which often act as dynamic resistance. Momentum indicators have spent more time in the lower or middle ranges, reflecting persistent selling pressure. The chart is important here because with an unprofitable growth name, technicals and sentiment dominate. Key levels. There's a zone of support under current price where buyers have stepped in previously. If earnings disappoint and that area breaks, you have downside air. On the upside, there's a clear band of resistance where previous rallies have failed. That's the level the stock needs to reclaim for a trend change. Roblox reports Thursday after the close. This is a binary event for a stock like this. If they beat on revenue, show strong bookings, and give good commentary on engagement and progress toward profitability, the stock can spike hard. If they miss, guide cautiously, or show slowing user metrics, it can sell off sharply. My approach, from a risk-reward perspective, this is for aggressive traders only. You can sit it out and wait for earnings to see if a new trend forms, or trade it very small, expecting volatility, or use it purely as a post-earnings momentum play, trading the move after the numbers are out. This week, I'd personally treat RBLX as a watch and react name rather than something to size up before the report. Enphase is in the solar and energy technology space, mainly known for its microinverters and residential energy systems, and increasingly for battery storage. Over the last couple of years, the entire solar complex has been crushed. Rising rates hurt long-duration, policy-sensitive names. There have been inventory and demand headwinds across installers and distributors. As a result, Enphase's stock price is way off its highs. The interesting part now is that after that huge reset, you're starting to see cost-cutting and restructuring, more rational inventories, and some upgrades from big banks. which suggests they think the worst may be priced in. Fundamentally, Enphase is a company with strong technology and high gross margins when the cycle is healthy, levered to policy, installer health, and housing consumer demand in the middle of a reset, cutting costs, realigning production, and expanding into battery storage, which is higher margin and a big long-term opportunity. Key points you can mention: the company has taken steps to cut operating costs, including headcount reductions and efficiency initiatives. The long-term energy transition story is still intact. Solar plus storage is a secular trend. The main question is timing. How long does the reset last before growth and margins reaccelerate? Technically, Enphase has been trending down for a long time, but recently started to stabilize and bounce off the lows. Prices often now trading near or just above some of the medium-term moving averages, which is a subtle shift versus persistent breakdowns. Momentum has gone from deeply oversold to more neutral, and in some cases, you might see the MACD turning up, which supports a potential early-stage recovery. Important levels: there's a support area at the recent lows. If that breaks, it suggests the downtrend isn't done. On the upside, there's a resistance level not far above current price. If the stock can clear that after earnings, it would confirm buyers are stepping back in. Enphase reports Tuesday after the close, and that's a major event. We've also seen recent positive analyst calls from major banks effectively saying channel inventories are easing, the demand picture into 2026 looks better, cost actions should support margins. How I'd frame it for viewers: if you're looking for a higher beta turnaround style clean energy play, Enphase is one of the more interesting charts after the big drawdown. The combination of fundamental reset, recent upgrade, and improving technical picture makes it a reasonable watchlist buy candidate, but it's still volatile and earnings sensitive. For this week, conservative traders wait for earnings, then look for a breakout above resistance as confirmation. More aggressive traders scale in small, but no earnings can move this name hard in either direction. Fourth is Corsair Gaming, ticker CRSR. Corsair sells gaming peripherals, components, and streaming gear. Keyboards, mice, headsets, cases, cooling, and content creator equipment. The bull case sounds good on paper. Gaming and streaming are secular trends. PC hardware cycles and new GPUs consoles can drive upgrade cycles. Corsair has strong brand recognition in the enthusiast space. On top of that, you'll often see arguments that revenue is growing, gross margins are improving, and the stock looks undervalued relative to some intrinsic value estimate. The problem is what's happening at the bottom line and in the chart. Fundamentally, despite improving revenue and margins, the company is still unprofitable. Losses have actually widened in some periods, even as top line grows. If a business can't translate higher sales and better gross margins into actual earnings, the fair value models start to look too optimistic. That's what people mean by a value trap. It screens cheap, but it stays cheap or gets cheaper because the underlying business never fully turns the corner. Technically, Corsair has been in a clear, persistent downtrend. Price trades below major moving averages. Rallies tend to fail at those moving averages, then roll over. Momentum has been negative, with oversold readings that produce only short-lived bounces. Levels. Price is at current all-time lows, meaning there isn't any historical consolidation to base entry decisions at these levels. On the upside, there's a cluster of resistance. If the stock can't reclaim and hold above those areas, any bounce is just a bear market rally. You'd want to see a clear trend reversal, higher lows, a break above key moving averages, and better momentum. Evidence in future earnings that losses are narrowing and the path to profitability is firm. Now let's talk about one of the stronger names on this list, United Parcel Service, ticker UPS. UPS is a global logistics and parcel delivery giant. It's a classic large cap cash generative dividend paying stock. Right now, the narrative looks like this. The company has been resetting its relationship with Amazon, willing to walk away from some lower margin volume. They're focusing more on profitable segments, optimization, and automation. Recent earnings have been better than feared, and guidance has been constructive. Fundamentally, UPS checks a lot of boxes. It's profitable with solid operating margins for a logistics business. Free cash flow is strong, supporting a healthy dividend yield and capital returns. Valuation is reasonable. It trades at a modest earnings multiple compared with its history and with the broader market. Recent earnings have shown revenue and EPS beats versus expectations, clear messaging from management on cost cuts and network optimization, reasonable guidance for the coming year. On top of that, it offers a high dividend yield relative to many other large caps, the potential for margin expansion as they shift mix toward higher margin customers and automate more of the network. Technically, UPS has been trending higher recently. The stock has bounced from the lower part of its 52-week range and is moving toward the middle upper region. Price has moved above some key moving averages, which often act as support in an uptrend. Recent price action shows a series of higher lows, indicating buyers are stepping in on dips. Levels I'd focus on: support around the recent breakout area. That's where dip buyers may defend if we see a pullback. Resistance around the prior swing highs and around where analysts have clustered their price targets. If UPS can hold above that support zone and push through resistance with strong volume, that validates the idea that the market is re-rating the stock higher on the back of the improved outlook. Among the 6 names we're covering today, UPS is one of the cleanest risk-reward setups: strong cash flowing business, reasonable valuation, solid dividend, improving technical trend, clear fundamental story around mix shift, cost control, and margin expansion. For conservative or income-oriented investors, UPS fits well as a core position or accumulation candidate on dips. For traders, the recent breakout and analyst upgrades make it an interesting name to ride as long as the trend stays intact. Lastly, we've got Nike, ticker NKE. Nike is a global mega brand in athletic footwear and apparel. The brand's strength and long-term track record are unquestionable. The issue lately has been execution and growth. Revenue growth has slowed and even declined in some periods. Operating margins have compressed significantly from their prior highs. The company has faced inventory issues, promotional pressure, and increased competition from up-and-coming brands. So the story is no longer a clean growth compounder, it's more of a turnaround. Fundamentally, revenue has come down from its peak and growth has been muted. Margins have taken a hit due to excess inventory, promotions, and softer demand in key regions like China. Earnings growth has stalled and even declined, which is a problem when the stock still trades at a premium multiple. On the positive side, the brand remains incredibly strong. Management has launched cost-cutting and restructuring, including job reductions and a renewed focus on key categories. Over a multi-year horizon, there's a plausible path to stabilizing revenue and rebuilding margins. But that's a multi-year story, not a quick quarter or two. Technically, Nike has been trading in a wide range, roughly between its lows and highs over the past year. The trend is not clearly bullish or bearish. Instead, it's more of a choppy consolidation with lower highs and lower lows in some stretches. Volume and momentum have been uninspiring, reflecting indecisive investor sentiment. Key levels: a support zone around the lower part of that range where buyers have stepped in, a resistance band near the upper part of the range where rallies tend to fail, until we see a decisive break, either above resistance with strong volume and improving fundamentals or below support on renewed weakness. Nike looks stuck in wait-and-see mode. For this week and the near term, Nike is less interesting as a short-term trade and more relevant as a long-term patient investment. If you believe in the brand and management's ability to execute a turnaround, short-term with muted growth, margin pressure, and a still elevated valuation, there may be better opportunities elsewhere. On this watch list, I'd tag Nike as hold, monitor for evidence of stabilization in revenue and margins. Consider accumulation only if you have a multi-year horizon, and preferably if the stock comes in closer to the lower end of its range again. That wraps up this week's 6-stock watch list. Quick summary: PayPal, PYPL. Solid fundamentals at a reasonable valuation with earnings Tuesday acting as a key catalyst. More of a value. Selective buy on confirmation. Roblox, RBLX. High growth, but unprofitable and technically weak, with a binary earnings event Thursday. Strictly for aggressive traders. Enphase, ENPH. Beaten down clean energy name now in reset and recovery mode with a better technical picture and a major earnings catalyst Tuesday. Corsair, CRSR, improving on paper but still unprofitable and in a clear downtrend. UPS, strong fundamentals, solid dividend, and an improving chart. One of the best risk-reward names on this list. Nike, NKE, elite brand in a turnaround phase. More of a long-term patient story than a short-term trade. This week, also remember the macro backdrop. Friday's non-farm payrolls can move the entire market. Earnings for PayPal, Enphase, and Roblox will likely be the main drivers of these specific names. If you found this breakdown useful, hit the like button, drop a comment with the ticker you're watching most closely, and subscribe if you want this kind of watch list every week. If you want to go deeper, I'll have a post in the Discord with more detailed notes and levels for each of these charts. Thanks for watching. Trade safe, manage your risk, and I'll see you in the next one.